Hello and welcome to Bytesize, a newscast on number 9. We got some exciting topics for you guys today, so let's jump right in. First up, Canada plans to issue a digital tax from 2022 onwards. We're going to have a look at what this is, what this tax plan looks like, and how it might actually affect the company you've invested in. The second topic for today's newscast is on the act that passed Congress. This is the Holding Foreign Companies Accountable Act, and I want to shed some light on this act as it contains some very common misperceptions. After that, we have a good news. Looks like the infamous S&P will launch a crypto index. We'll look into this in detail and find out what it means for the cryptocurrency space. Finally, the European Central Bank plans to print another 750 billion euros. That's a lot of money and the consequences are quite significant. What those are, you'll find out in this element of the newscast. Now, before we jump right in, some housekeeping. If you like the content or have questions, please leave a comment down below and don't forget to hit the subscribe button. This way, you'll stay up to date with the most important economic developments as they happen in the crypto and wider economic space. Also, the following is not financial advice, it is strictly educational. The topic I want to engage with you guys here is on Canada's digital tax plan. Now, the article itself is quite short, but I actually have quite a lot to say on the matter, so bear with me on this one. First, I think this is something we're going to see a lot more of. As many of you probably know, it is relatively easy for these big corporations that are mostly digital to avoid taxes. Companies like Google, Amazon, Facebook, etc. are all pretty good at finding ways to avoid paying taxes. They will register part of their company in a tax haven like Luxembourg, send all their income through that country, and avoid paying taxes in countries in which they operate. Now, this over the last couple of years has become more and more evident and has allowed these big tech companies to just grow like crazy. And Canada, for one, is no longer putting up with it and implementing a couple of new laws to curb these companies. The first major one being straight up taxes. Now, this is an easy one. Instead of paying taxes in tax havens, the Googles of the world will have to start paying taxes in countries in which they actually operate. This to me just makes sense from a rational perspective. I mean, it makes sense that if you operate in a country and offer a particular service, then you should just pay taxes. Now, the impact of this will be felt by any big tech company operating in Canada. And if these laws are implemented in more countries, which I tell you they will be, it stands to reason that these companies will take a sizable hit. On the other hand, however, there's a good reason for suggesting that these services that these companies offer will just become more expensive. And what I mean by this is, if Google has to pay taxes on products they sell in the Play Store, for example, it stands to reason that they will simply increase the price of these products and point the fingers at the governments saying they made us do it. Now, regardless of who you pass the blame on, it will hit their income stream negatively one way or another. More expensive products probably means fewer purchases, which means less profit for Google, for example. Now, second, and this is already live in a lot of countries, so it's not that super surprising. And this is for short-term rentees, aka the people renting out apartments on Airbnb, for example. And it's to pay a holiday or sales fee. The reason for this is twofold. On the one hand, it stops or disincentivizes people buying up apartments, condos, houses, and other things in order to rent them out on Airbnb. On the other hand, it'll help hotel chains be more competitive because quite frankly, right now, a lot more people are going to an Airbnb than a hotel. And that's because Airbnbs, the prices are often lower, the services are way more personalized, and quite frankly, the locations tend to be a lot more better and unique. Now, personally, I'm all up for people renting out their apartments or rooms to others. I mean, it's the democratization of hotels. I'm all in for it. But at the same time, the effect is that people are simply buying up houses in order to sell them or rent them out on Airbnb. That in turn drives up the prices of houses and makes them less accessible for starters, for example. Now, I can personally see both sides of the story on this particular topic. Once again, I'm all in for the democratization of hotels, and by which I mean I'm a proponent of people renting out their spare rooms for a little bit of cash on the side. But then again, people are really professionalizing this, and it's driving up the house prices due to the fact that houses are used for Airbnb cash cows. Also, don't forget that hotels offer a lot of employment to lower skilled workers such as cleaners, kitchen, and service staff. These people will simply go out of a job if hotels start shutting down. So honestly, I'm really divided on this one because I can see both sides of the story. Whereas the tax one is more evident, this one is more difficult for me to actually have a strong opinion on. Now the third ruling, I haven't seen much of, but the third one is clamping down on stock options for large corporations. The reasoning from the Canadians here being that these high net worth individuals get paid in stock options rather than in wages. And that's because on wages they would have to pay a fair bit of tax, and stock options are a lot cheaper to be paid in. Now you may ask yourself, why would a country like Canada do this? Well, it makes sense if you want to get more taxes from wealthy individuals. If they found ways to avoid paying taxes by getting paid in shares instead, then, you know, diminishing their ability to get paid in shares is an exceptionally good way to get more taxes from these people. You may ask yourself, what is the effect of this on the company in which I've invested? What is the effect on the share price? Now, this depends largely on the company itself. If, say, the shares paid are completely new issuance, then it's a good thing for the share price of the company. This is because the shares will not be diluted. And what I mean by this is, let's say a company has 100 outstanding shares in the market, but then decides to pay their employees into shares, thereby doubling the amount of outstanding shares to 200. This means we go from 100 to 200 shares in the market. This doubles the dilution of outstanding shares and technically makes them less valuable on the open market, especially if at some stage these new shares, newly issued shares, get sold by the employees. So in essence, having fewer shares on the open market, this the price should technically be positively influenced. Now the reason I say technically is because it depends on how these employees were paid previously. As you can imagine, these high net individuals, they do want to get paid. And if they're going to get paid the same amount in cash as they were in shares, it's reasonable to expect that this will have a negative effect on the company's free cash flow. Now, this simply has to do with the fact that the costs for employee wages will go up a ton. Now, this cash was previously available to spend on expanding the company or maybe even buy back shares. Now, what it means for you personally, if you are a stock owner of a company affected by these rules, depends largely on how this company was going to deal with the new rules to begin with. Now, what I have given you here is a set of tools with which to reason. Ask yourself, will they pay the wages? Did they issue shares to employees before? What structure will your company take on after these rules take effect? Now, if you have any questions on this or perhaps have a question for a specific company, drop it in the comments section down below and I'll get back to you. Ultimately, what I predict is we'll see a lot more of this, of these rulings, these digital tax rulings. Countries are sick of these large corporations finding ways not to have to pay taxes. It means they miss out on a lot of income, and it also gives these big corporations an unfair advantage over other smaller businesses that do not yet have the sizable bookkeeping team that can come up with smart ways to avoid paying taxes. Now, I believe we'll see more and more countries try and clamp down on big tech giants in order to, let's say, harvest taxes and at the same time offer a more competitive landscape to startups trying to compete. The next topic I want to, shed some light on because it has a couple of intricacies and common misperceptions is a new bill that has passed Congress. And this is on accounting, right? Accounting for major corporations. Now, what this essentially comes down to is that in the United States, there are some rules if you want your company's shares to be listed on a stock exchange where they can be bought and sold, like the New York Stock Exchange, for example. Now, not only are there rules, but it's also mandated that an independent third party is able to look into how a business does their accounting. And this hopefully stops accounting fraud and makes companies more accountable and makes research more trustworthy. So it's an overall good thing, right? Now, what I want to point out here is that this new act, the Holding Foreign Companies Accountable Act, is not only aimed at Chinese companies, right? Instead of is all corporations listed on American stock exchanges. They're all going to be held to the same accounting standards as American companies. Now, a lot of people are screaming from the hills here that this bill will be the death of Chinese companies listed on stock exchanges and these delistings are going to happen overnight. But this is not true. And this has to do with the fact that companies have 3 years in order to apply with this new Accountability Act, right? Now, what I do imagine is that some companies will shift their listings to other exchanges like Hong Kong or the Cayman Islands. But this to me would seem kind of fishy. Imagine if a company you had invested in did not feel comfortable having an independent third party look at their accounting. How would that make you feel as an investor? I'd say probably not good. Now, personally, I'm all in for accounting oversight. I mean, I want to be able to trust the numbers I find on 10Ks and 10Qs, which are the annual and quarterly reports of a company's financials. Especially if I want to analyze how a company is doing, right? So I think this is a step in the right direction, and I would remain highly skeptical of a company who delists because they don't want to have extra oversight. Now, a short recap here on this one. Um, First, the Holding Foreign Companies Accountable Act applies to all international companies, which I think is great. Everyone should be held to the exact same standards, especially if the standards are high, right? And fear not, this isn't happening overnight. Companies have 3 years to comply. So the last point being that, if they have 3 years to comply, I'd remain highly skeptical of a company who chooses to be delisted um, overnight. If you have 3 years to comply and you delist overnight, that's kind of fishy, right? So if you've invested in companies like these, I would remain highly skeptical of their accounting capabilities. The following is an article I found in Reuters. Its title is S&P Dow Jones. The following is an article I found in Reuters. The title is S&P Dow Jones Indices to launch cryptocurrency indices in 2021. Now, before we delve into this one, you guys all know what the S&P 500 index is, right? Well, the S&P 500 is in fact an index of the largest and generally most profitable companies in the United States. And investing in an S&P index fund has been recommended by the likes of Warren Buffett and Ray Dalio and other successful investors. And it's an excellent way of exposing yourself to the very best companies the States has to offer without buying stocks in each and every single one of them. And on top of that, an index is regularly rebalanced, so you don't actually have to do that work for your portfolio either. Now, an index is also a very good indicator of the general health of a market. On top of that, in order to get onto an S&P 500 index, for example, a company has to adhere to certain selection criteria. This includes a large market capitalization, a single stock must be worth more than $1, there's a minimum monthly trading volume, it must be listed on the New York Stock Exchange or the Nasdaq, and a company must be a company, maybe even a holding, but not like a limited partnership, for example. Now, returning to the article I wanted to actually discuss in more detail, what does a cryptocurrency index mean for crypto? Well, as you can imagine, it's pretty legit. It legitimizes crypto. It's a giant step in the right direction to legitimize crypto. And on top of that, it opens the door for investment products like ETFs. And you can imagine, similar to not having to go out and buy a stock in a single company, not having to go out and buy a single crypto, every single crypto, in order to be exposed to the market saves a lot of time and effort. And finally, I think this one is pretty big. Having certain selection criteria will keep scam coins and other crappy blockchain products out of an index. This will further drive up the cleaning of the crypto space and make it more comfortable and a safer space for investors with less knowledge of crypto to still gain the exposure they want. Now, overall, I think this is a massive win for crypto. I'm very excited to see the S&P top 100 or 500 or top 10, and I'm also curious to see what the selection criteria will be. The final topic for today is not unimportant in the global macroeconomic space. The ECB, which is the European Central Bank, is considering printing another 750 billion. Now, what that looks like you can see over here. This is the amount of money being printed at any given time, and as you can see, the increase is quite significant. Now, in sum, what we'll be looking at is a grand total of 2 trillion. That's 2,000 billion euros for the next year and a half. That's a lot of money, and it will be used to stimulate the economy as it comes out of the COVID slump. Now, there's 3 reasons why I want to get into this topic a little deeper and explain to you guys what's going on here. The first being simply because of the staggering amount of money being printed due to the dire economic outlook for the Euro region. Now, this is a lot of money and kind of gives you an idea of how bad things are economically. The second reason being that actually getting this money to work in the economy seems to be a problem. Now, I covered this concept in depth in a previous video, but let me just quickly recap. The way the ECB prints money is by buying bonds. This in turn gives banks and money lenders more cash to lend out to businesses. These businesses can then go out and spend that money on expansion like wages and materials. And that in turn puts money into the economy and stimulates growth. Now I want to introduce a certain term to you guys here called the velocity of money. Now let me quickly tab to Investopedia and read it out to you. The velocity of money is the measure of the rate at which money is exchanged in the economy. It is the number of times that money moves from one entity to another. It also refers to how much of a unit of currency is used in any given period of time. Simply put, it's the rate at which consumers and businesses in an economy collectively spend money. Now, in other words, it is the speed at which money changes hands. Now, let's say Bill and Jane give each other money on a daily basis. That means the velocity of money between those two people is very high. Now, if Bill decides to pocket the money Jane gives him every single day and gives her nothing in return, that means the velocity of money is very low. Now, the problem in Europe right now is that the velocity of money is very low. Banks, businesses, and people are choosing to pocket their money rather than spending it in the economy. That means that the act of actually printing money has very little effect and simply sits as a bubble at the top. It's like a big bucket of cash sitting on top of a hill that refuses to come down and feed the thirsty grass. So Europe's in this weird situation where their central banks want to stimulate the economy by printing money, but this money isn't getting anywhere, which in turn wants them to print more money because the economy needs to be stimulated. And printing money is the only tool central bankers have at their disposal. Now, I'm by no means a central banker and I don't have all the knowledge they do. But my relatively basic knowledge of these concepts kind of points out to me that there's this big bubble of cash sitting on top of a hill that needs to come down at some point. And I think when it does, when the velocity of money starts to speed up, inflation is just going to be insane. Just imagine what will happen when these 2 trillion euros start to make it to the economy. That's a lot of inflation. Now, the final thing I want to point out to you guys is that this money printing is happening in all regions of the world, be it Japan, China, or the US. And you can see that here. Japan unveils 708 billion in fresh stimulus, and the US is looking at 908 billion. So what this indicates to me is that it's a concerted effort by all global banks to stimulate the economy. Now, one reason they're all doing this is because as long as currencies are all being printed at the same rate, there will not be too many currency imbalances. Now, what I mean by that is, like, let's say the US does a ton of printing and Europe does not. This will devalue the dollar versus the euro and destabilize the trade between these countries. This is because Europeans will be able to import more from America because their currency is stronger, whilst the Americans will have a difficulty importing from Europe because their currency is weak. And this is a destabilization that we just prefer not to deal with at this time. So what this comes down to is not to disturb the trade and money markets. Central banks from all over the world seem to have agreed on printing money at the same rate. Now that's a lot to digest, so let me just quickly recap. First, the ECB printing a lot of money demonstrates how bad things are economically. On top of that, the velocity of money is low. The money is not helping, and it's not getting there. So the effect of it is we need more stimulus because that's the only tool the central banks have. Now, it appears as if central banks around the world are doing this at the same time in order not to disturb trade. And this to me all sounds like some sort of crazy monetary experiment that we're all part of. I'll be very interested to see how this plays out, and I do aim to keep you guys informed on some development. I find it highly fascinating, and I do believe we're part of financial history right now. So what have we learned today? On the Canadian tax reform for 2022, it looks like it'll be a combination of straight up taxes on companies operating in Canada, coupled with taxes on short stay accommodations like Airbnb. And finally, the Canadians are looking to clamp down on stock options in order to force CEOs and the likes to take pay in cash instead. This way it's easier to tax the wealthy CEOs on their income. Now, the Foreign Companies Accountable Act has some common misperceptions that we set right. The first being that it's not exclusive to Chinese companies. Instead, it's aimed at all international companies. Now, please take note that these companies have 3 years to comply, so the act will not take effect overnight. With this in mind, just be wary of companies that decide to delist immediately. Now, on the act itself, personally I feel it's a move in the right direction. Extra oversight for accounting fraud is what I would consider a good thing. On the topic of the S&P Crypto Index, I believe this will further legitimize crypto and lead the way to crypto ETFs. Also, as the S&P Crypto Index will have selection criteria, it will disincentivize scam coins, as they will not be part of the index. Finally, with the European Central Bank planning to print another 750 billion euros, as the economic outlook for the EU region looks rather dire. On top of that, the velocity of money is incredibly low. This means that the money the central bank is printing isn't getting to the people, nor is it stimulating the economy. This means that the economy isn't actually recovering and the ECB will have to print more money because this is the only tool they understand. And finally, this money printing seems to be a concerted effort by banks all around the world in order not to disturb the trade between countries. This concludes Bytesize Newscast number 9, guys. Once again, don't forget to like and subscribe to stay informed. Thank you so much for listening, and I hope to see you next time. Bye!